All right, welcome back to the channel. Today we got some drama going on. Dollar General reported, and they took a nice little nosedive. They're down about 10.3% over the last 5 days. I think I saw in the morning they were down about 17% on the day. Currently, they're down. I think they closed down, down 12.15% on the day. So, yeah, I wanted to just kind of make another video going over the previous evaluation model that I made for Dollar General, just kind of update my thoughts around it, and share that with you guys. So if you haven't seen the original video, I will link to that somewhere around here, somewhere on the screen or in the description maybe. So check that out after this video, and you can kind of see what I said back then on it. So kind of a rough breakdown of what happened with Dollar General is, like most retailers, shrink was worse than they expected. They missed EPS by about 13% on the quarter, 13.52%. Revenue miss was about 1.15%, and they guided down. So they, let's see, their guidance went from about 3.5 to 5% growth to 1.3 to 3.3% growth. So, yeah, just for net sales, same store sales got downgraded as well. EPS guidance got cut as well. So yeah, it was just kind of like one thing after another. That earnings call was fun. Go listen to it. You can really, it's fun watching or listening to the analysts just kind of rip into them. But kind of the commentary for management, just give you a brief overview, was that shrink was higher. Their sales were, well, inventory is kind of getting under control, but not that great. They're going to keep up investment, and they're actually going to raise some investment into, I believe, wages and staff, which is going to have a little bit of a drag on it. Still not doing buybacks. Dividend was kind of same old, same old. I think they're going to maintain the dividend. But yeah, the guidance just did not look good. So they're pretty much going to be focusing on some of the current investments that they have going on right now, and that will hopefully increase operational efficiency going forward. They go through kind of a slew of that, listening those things. So highly recommend listen to the earnings call. It was a fun one. Going to the evaluation template, what we're gonna see here, and I will zoom in for you guys so you can see it a little bit better. Let's see, 150%. Let's see, there we go. So I tried to make this as close as I could to the previous model. Let me change this real quick. And yeah, there we go. All of the figures should be pretty close. We are still normalizing. We're still doing net income only. The yield spreads, dilution, all that type of stuff should match, because I just wanted to show the base of where I started off and any changes that I'm going to be making, and just kind of talk through it. So it is kind of interesting. The one thing that I will criticize myself on is that I probably should have started with a higher KGAR target when looking at this, because assuming that the macro got worse, the consumer got worse, the consumer tightened, and DG was affected more, or Dollar General was affected more by that, there was a realistic chance that their margins would contract pretty nicely, and we could see some pretty good downside action. So the stability of their cash flows, I think, I was questioning them back then, and even though I was questioning them, I really didn't have that high of a target KGAR. It's about 15% total. So if I wanted to, I could say, okay, now sentiment is like really bad on this, and let's do a target price KGAR of 17.5%. And that's almost a 20% total KGAR with including the dividend. So that brings our scenarios down a bit. Previously, it was kind of in that base scenario was 152 buy point and 126 buy point for the scenario 2, or the lower end scenario, 100.05 for the base, or for the low end. I'm not really sure if I want to change any of the growth numbers, honestly. I personally, where I'm leaning on this is that, yeah, we're going to see contraction of margins, but I'm trying to think of like, where our margins going to be in, 2025, something like that. Forward looking a little bit more than probably what the market is looking at. Market's probably going to be looking at about 6-9 months. I'm probably going to be looking at about, I don't know, a year and a half or so. Because if they can recover those margins and they're growing top line, they gain those efficiencies, then, you get a normalization and a recovery of earnings from the margins kind of recovering as well. And if we look at the ratios and metrics, we can kind of see their margins over the last 10 years. And yeah, we are in a recent kind of downtrend. Yeah, but overall, it's been pretty stable over the last 10 years. So is this going to be a one-time thing, or this is just something that their investments is going to be a little bit higher than normal for a short period, and their margins are going to eventually recover from this as maybe they get inventory under control, shrink goes down, and hopefully the consumer strengthens a little bit for their target demographic in, 2025 or so. That, we'll see. That kind of leads to like a macro question of, what are interest rates going to be? What's wages going to be? What's, that's going to play a lot into this. So, yeah, I going over to the valuation sheet here. I still think like under this scenario, under this lower target CAGR, maybe I could increase the negative scenario spread of the bottom line growth numbers and say, okay, like maybe they only grow at like 3.62, or instead of normalizing, I remove the normalization and keep the original scenario spread. And we're kind of starting off from a lower metric, right? So, and that gets us right into around the $100 area for some of these lower scenarios at the 13.5% target CAGR. It's a bummer that they basically are no longer doing their buybacks in 2023. That was already known. We knew that it was at least last quarter. I think they announced it going into 2023. But if they are going to continue to drop, the price action drops towards that $100 level, it's a real shame that they're not going to be doing buybacks at that range. At a certain point with the valuation, I like to see companies in a kind of a position of strength to be able to allocate that capital towards buybacks. So that's a little bit disappointing. If we increase the scenario and do negative 25 and say 2.79%, we get into that $80 range, 99 to 80 in the more bearish scenarios. But I don't know, like I am more inclined now. Like I'm still pretty confident in my original numbers. It was still just expensive previously. It's getting more interesting now. I think if you were buying this at 250 or whatever it was, that was really, really rich. It's getting a little bit more interesting now. It'll be interesting to see if they can kind of improve those efficiencies, lower the shrink amount, recover their margins to their historical point and historical like 10-year average, and just keep on chugging along. If they can do that, I mean, we're getting into some pretty interesting levels. Yeah, 17.5 is probably too crazy for that, but yeah. If they're able to recover those margins, I think we could, or even signs of recovery of margins, we could see a nice move on the stock eventually, but I do think this is going to take a decent amount of time to play out. We might not see that until like 2024. If we look at the revenue, they're still growing revenue pretty good, but a lot of that recent growth has been from net store ads and not same store sales. So It's gonna be interesting. It's gonna be interesting to watch this one. I think the price is definitely getting into some more attractive areas, where you have a little bit more. I don't know. There's unknowns, but there's I don't know. There's always unknowns. I think scenarios I pointed out in the last one, and kind of the thesis behind the last one, with either a weakening consumer dragging this down pretty heavily. This one could really just be pegged to the strength of their consumer. If we see a recovery in that consumer demographic, and they strengthen, a Dollar General could ride that kind of pretty well. So I don't know. We'll see. We'll see what happens. Hope you guys had a great day. Yeah, I am continuing to just keep an eye on this one, as well as other retailers. ASO reported today; they did great. They kind of had the inverse. They had margins that held up, and I think even expanded, but their top line kind of shrunk. So, but the market reacted really nice on that one. And then I believe ANET just did an upgrade of, or not ANET, but a analyst upgraded ANET's, and yeah, so I think they got a price upgrade to like 220 from 170. So it's been a fun couple of days. There's been a lot of drama in the market, and yeah, it's interesting to see everything just kind of react, and people freak out, and I'm like, okay, this is starting to get a little bit more interesting. But man, hope you guys have a great week, and we'll see you in the next one. As always, this is not financial advice. This is just my musings and looking over another company. So do your own research, your own valuation, everything, and do not, buy or sell or do anything based off of a guy, on YouTube.